Welcome to Capital Raising, Understanding the Investment Landscape, brought to you by Ascento Capital, Flatiron Law Group, and ShareVault. My name is Anthony Wilson with ShareVault. ShareVault's industry-leading virtual data room technology puts your deal on the fast track by giving you the tools to show confidential information with the people that you need to trust today, but don't know if you can trust tomorrow. The purpose of today's webinar is to give CEOs, CFOs, and other C-level executives who may be new to fundraising a faster path to a starting point. So thanks for participating. Let's go ahead and get started. So I'm excited to introduce Ben Boissevain from Ascento Capital and Conrad Everhard from Flatiron Law Group. So Ben, thanks for joining us today. I'll go ahead and kick it over to you.
Great. Thanks so much, Anthony. Yeah, so my name is Ben Boissevain. I am the founder and managing partner of Ascento Capital. We're a boutique investment bank located in New York City, focused on the tech sector and focused on helping companies raise capital as well as M&A advisory. And I'm joined by Conrad. Conrad, you want to give a brief intro?
Hey guys, I'm Conrad Everhard. I'm one of the founders of Flatiron Law Group. I'm a former big law partner, turned technologist and revolutionary. I've been working principally my career in the technology sector, venture capital, private equity, M&A. Most interesting for you guys, I was also in the private sector. I was a VP and general counsel of a big venture-backed solar manufacturing company of the Cylindra age called AE Polysilicon. We raised over $200 million, Ben, and astonishingly enough, we lost it all, which my ex-wife says is very hard to do, but she gives me credit.
Great. All right. Thanks, Conrad. So we're going to look at the funding source in today's climate, appropriate funding source at each stage of your business, which is extremely important, and practical steps you can take to maximize success. Next slide. So this is the minimum timeline. This is pretty optimized, I would say. I was just reading a piece on Canva, the company Canva, for design, logos, etc. It took the CEO 3 years and like hundreds of rejections to get funded. So this is optimized. I've seen deals done this fast, but it's good to understand the process, and it's always good to get prepared as well. So I'm just going to walk through the steps, and Conrad, if you could just comment along the way, like step one, define strategy, needs, and goals, which is really critical to figure out how much money you need. And Conrad, you had a great comment there.
Well, I mean, guys, there's a tension when you want to raise money between raising as little as possible, because raising money is dilutive. When you raise money, your company is issuing new equity to the investors, and your share of equity is being reduced. That's called dilution. So the more money you raise, the more diluted you are. But the other tension is you want to raise enough money to be comfortable that you don't have to go back and raise more money before you reach your next objective. So that's the tension that occurs in the first step. And the other issue in this first step, Ben, is while we don't ever recommend people to go out with a fixed valuation. Sometimes that works. You have to have an idea in your mind what valuation you're shooting for, and we'll talk about valuation more later. But that's another critical component at this stage.
Absolutely. Makes sense. Step two is a world-class pitch presentation, which is extremely important. You really want to have a pitch deck that has been gone over many times, tells a great story. It is storytelling, and there's a lot of online resources on pitch decks that have landed a lot of money, so it's worth doing the research there. Step three, we'll walk through this on the different steps as well in terms of the suitable investors. If you're going for Series A, go for Series A investors. You also want to look in your geography typically as well, and then people with experience in your sector. So it should be really focused as opposed to scattershot. Step four is to pitch to investors and expect a lot of rejections. Conrad, I think you'll attest to that you have to pitch to 100 to get one, right? That's typically the ratio.
Yeah, you have to, the really important thing about making presentations is your ability to pivot. Don't be dogmatic about the sequencing of your presentation. Go to where the investors want to go. And if they're interested in particular topics, be flexible and nimble to be able to switch from one topic to the other, and don't try to force your sequencing.
Yeah, great point. And the other point there is to learn from your rejections. Like, why did they reject it? Try to get as much information as possible. Could be not enough market data, as an example. And the next pitch deck, you want to have a lot of market data. There's a lot of things you can learn in the process. Step 5 is typically where the banker, but primarily the lawyer, with Conrad's experience comes in. Want to comment there, Conrad?
Yeah, well, as a
Negotiating terms.
practical matter, the negotiation of the term sheet is where all the action is at. There are not all that many business issues, and they've been fairly institutionalized over time in terms of the economics and control. So when the actual rendering of the definitive documentation is based on model documents. You can go to the National Venture Capital Association and model documents, and that's the form that many Silicon Valley lawyers use. So it's what's really important is the term sheet, because the term sheet, even though it's non-binding, will set out all the critical issues, including valuation, economic rights, and management rights.
Yeah, fantastic. Exactly. And then step 6, we've got a whole slide on this later, but satisfy investors' due diligence, which is
this guys is clearly the most transactionally stressful step, and it's the step that's mostly that's largely under your control, because the better organized you are and the better your documentation is presented, the quicker that process will be. It's the area where there's going to be stress on management to produce responses to the requests from the investors.
There's a lot of advantages in that, just to put in this for ShareVault, but to have a professional data room like ShareVault, because you can track who's actually hitting what in your data room. Just as an example, if they're hitting your capitalization table a lot, like the 20 minutes there versus 1 minute somewhere else, then you can expect a lot of questions in your cap table. So it's super useful to have professional data room as opposed to just a Dropbox. Next, please. Okay, this is the company stage and investor landscape, and it's different investors all the way along the roadmap here, along the journey. Timeframe, business stage, proof of concept, POC, typically an idea or a concept, money to build a minimum viable product. You can do a lot of this stuff really cheaply these days, so try to figure out how much you really need for that. You have your pre-revenue at that stage. Next stage is startup, minimum viable product build up to 1 million. Early stage, you're starting to get customers, and you can do this much faster. This is pretty idealized as well. Product build, get 1 million, 500 to 2 million for the early stage. Mid stage, you got a proven product, customer growth. You're going to grow and scale, and growth is key. We'll get into that a bit later, but profitable growth is changed a lot these days, from just growing at all costs to profitable growth and path to profitability. That's 1 million to 100 million. Expansion stage, profitable, on track to profitability. Just sales. 100 million to 500 million. Growth stage, you've got a strong team, probably bring a professional CEO, scalable formula, 500 million to 1 billion, and then late stage, proven track record, M&A exit, 500 million plus. I will say you can do the M&A exit much earlier, and it should be always one of your options to look at, because 90% of companies will exit, and 90% of those will exit through M&A, and 10% of those will exit through an IPO. So take M&A seriously. I think the investment rounds down below, capital raised, is pretty similar. And this is a great chart, because it tells you if you're bootstrapped, you shouldn't be asking for 10 million, right? You should be looking at 50K. If your seed should be, 50 to 100K. Series A, you should look at, to Conrad's earlier point about what's market in the sector. You should look at what other companies are raising right now. And typically, the Series A was higher amount before, was like 20 million, 30 million at Series A. Now it's gone back down to 2 to 15 million. So it's gone back, reverted to mean. Series B, Series C, Series D are much larger amounts. Any comments there, Conrad?
Well, one of the issues to think about is when you're assessing your fundraising strategy, especially if you're a very early company, is how to structure yourself. Historically, in Silicon Valley, venture-backed companies were structured as C corps, as corporations that were taxable as corporations for tax purposes. But increasingly, people have used limited liability companies. We could do a whole webinar on the pros and cons of using LLCs, but from a guy in my case who got dragged into the LLC camp kicking and screaming, there are some pros to using LLCs. You can, the losses, the investors can take advantage of losses. Cash flow, to the extent you have any, is not trapped, in a C corp like it is there. And frankly, it can improve the exit profile. It creates a more attractive exit for buyers, so that improves your valuation. I mean, the cons about an LLC, of course, are logistically they're more difficult. They turn employees into partners essentially, and frankly, for a lot of investors, C corps are still the safe space to be. That's the space that they understand and appreciate. But that is something that you talk to your lawyers and your advisors about.
So Conrad, I have this question for you. So if you're an LLC and your investor wants to invest 5 million, but they want a C corp instead, how easy is it to transition to a C corp from an LLC? Is it easy?
It's easy the earlier you do it.
Okay,
And,
interesting.
The issue about converting from a C corp to an LLC becomes problematic when you've raised convertible debt, because convertible the IRS is going to treat that convertible debt as income if you convert from a pass-through LLC to a C corp, and that can create real complications.
Interesting. All right, great answer.
So
All right.
it's not something. I know everybody always says, well, we can just convert to a C corp.
Right,
It's
right.
not that easy.
Okay, good to know. So it's better to plan early in what you want to be. All right, next slide, please. Okay, so the funding source is critical, and along the journey, it's going to be different sources. So initially, angel round, friends and family, self. That's really critical. And friends and family are going to be investing in you as opposed to your company because they believe in you. It can get tricky if you're not doing well. If you go to Thanksgiving, they're going to be asking, how are you? It's really, how's my money doing? So it gets a little personal, but that's a logical source too. So don't neglect that. Incubators are interesting. They help. I would try to get out of them as soon as possible, but they certainly help start a lot of companies. Angel investors, we'll learn that a bit later. They're really super useful, but you want to make sure you have somebody that knows the sector. I've had companies where they had Texas billionaires from oil, and they gave really terrible advice for tech companies. So you just want to make sure you get the right match there. Venture capital firms are always interesting. We'll talk about that a bit later. Corporate venture capital, which is really the corporate venture capital arm of corporations. Microsoft has one, for instance. Commercial banks, it's really typically a debt lender. Private equity firms come later, and strategic acquirers come later, but it's good to make those contacts early.
A couple other potential sources. There's what used to be traditional private placement memorandums, where you have a private placement banker that puts out a professional private placement memorandum and raises money from bankers and lawyers and accredited investors. You don't see that very often in the tech space, but it does happen. And crowdfunding is now a new tool for raising money. We'll talk about that a little bit later as well. I'm not all that bullish on it, but it is a legitimate platform.
So current market conditions, there was just a new report issued, US VC valuations report, and liquidity crunch, Silicon Valley Bank, a war in Europe, declining economic conditions. It's put a lot of pressure on venture in particular, and the IPO window is pretty much shut at this point. Investors are focusing on profitability as opposed to growth at all costs. The valuations have come down dramatically from 355 to 90 million as a median venture growth pre-money. So you want to make sure your valuations reflect the market. Otherwise, if you have a 2021 valuation, it's going to be very, very challenging to either get funding or get sold. And that's the whole adjustment that's taking place between the buyers and the sellers and those with money and those that are seeking financing is the valuation and it's price discovery essentially. So what's your view on the whole market there, Conrad?
Well, look, you and I have been through this cycle many times. So a lot of young people haven't, and there's no reason to panic. The market goes up, the market goes down. There's plenty of money that's going to be available to invest in venture, and they're not going to be able to get the kind of returns they're looking for in other market sectors using different products. So there's going to be money to be invested in higher risk enterprises. And there are sectors which are clearly going to attract capital, artificial intelligence, clean energy, battery storage, and others, or it's just a matter of valuation. But this is cyclical and it comes back and forth. My daughter's in law school. She's panicking about the labor condition there, but I've been through 5 of those cycles. They come up, they come down. We're in a down cycle, but it doesn't mean, we're going to be there forever.
Yeah, and a lot of this is reversion to mean, which is a good Wall Street term, meaning that, if you look at 2017, 2018, we're back to those valuations and funding amounts. And we just had this huge pandemic bubble caused in large part by a lot of the printing press at the government level. So it's going to come back again. And, the key is to be super pragmatic on the valuation as well as patience. Next slide, please. Excuse me, next slide. There you go. Perfect. So who you seek out for investment depends a lot on what stage you're at. And it's really important to try to pinpoint, as mentioned before, where you're at. Typically, this stage is you have some customers, some revenue, amount raised from 1 million to 15, friends and family. Look at all the options, look at grants, incubators, crowdfunding, SBA loans, just do a whole list and see what's most realistic. One good trick on the right, which, I've used successfully for people and they've been successful with it, is look at like M&A exits and IPO exits in the last, call it 12, 24 months on Crunchbase. That's, you can get a free version of Crunchbase. So as an example, if somebody just exited e-commerce company for 500 million, they just sold it, then look at the early investors in that e-commerce company if you're an e-commerce company, right? So what that does is if you approach those investors, and there's, they list the angels, sometimes their name, which is fantastic. They also mention Series A. They mention the partner that's in charge of that investment. So let's take the Series A as an example. If the partner like Will Rogers is the partner, you want to approach that partner specifically because right now in his venture capital firm, he's a hero. He just made the money on this e-commerce investment that sold for 500 million. He was an early investor. He obviously made money. He understands the sector. So he's the perfect guy to approach. So that's how narrow and defined you have to be. Next point is, you can lower your burn rate. This is true for seed A, B with ChatGPT. I know it's kind of the craze right now, but it actually, you really can lower the amount you need. There was a good thing from a very prominent VC. It said, before you start your company with, one CEO, 2 engineers, and ChatGPT, but now you can just do 1 CEO and ChatGPT, right? Because you can do a lot of coding with ChatGPT, but it's looking at how you can decrease your burn rate, office costs, et cetera. You really don't need that stuff anymore. And then safe notes, Conrad, I'll let you do that piece because that's more you.
Yeah, so look, when we talk about when you talk about structuring your first round of capital, I mean, oftentimes the seed round, sometimes before the Series A round, what you're really trying to do is bridge yourself to a Series A round. You bridge yourself to a priced round. And you can do that by either raising convertible debt or convertible equity, which is called a SAFE. A SAFE is like it says, it's a safer form of convertible debt. It doesn't give the investor creditor status. The benefit of using a convert and not going directly to a priced round is, especially when you're raising small amounts of money, is it's much simpler logistically, and also it avoids forcing you to put a valuation marker in the ground before it's market tested. I mean, you can come to me and say, gosh, I'm raising, $10,000 from my sister at $100 million valuation. Then you got to go to the market and get a $5 million valuation. There's nothing worse than, guessing too low or guessing too high. Using a convert, it lets you avoid that risk, because you can punt that down the road. Now you're going to ask me, why would anybody invest in a convert? Because you're going to give them a discount to the next round. That's the way this game works. You're going to give them a 10 or 20 or 15% discount so that their debt money they put into the company will convert along with the institutional investors, when the institutional round is raised, at a discount to that price. It's a little bit technical, but that's the way the seed rounds are typically, staged.
No, and it's important too, because I've seen seed rounds that just have ridiculously high valuations, and that's a real problem. I mean, you think it's actually a good thing, but it's actually a bad thing to have like a $50 million valuation with no product sold, right? It's just you can't grow into that valuation.
It brings you into a down round, which
Exactly.
nobody wants a down round, because so you don't try to be too greedy, because it winds up backfiring.
Exactly. All right, next slide. So now we're in Series A. So theoretically, you've got significant traction. You need more money to drive further growth. The size is 1 million to 10 million. And you've got traction once again. So now you're looking at, very specific investors, because they only it's very specific investor to Series A. You're beyond the angels. So once again, on like an e-commerce example, you're in e-commerce, you're in the sector. So you want to focus on venture capital firms and even the individual partner of those e-commerce deals. If you're in New York, look at the tri-state area. Much easier to do than California. These guys typically, not always these days, but typically invest in a 50-mile radius, because they're, if a company gets in trouble in Kansas, they don't want to go out to Kansas all the time. Makes sense. Series A as opposed to B, C, or seed. And try to track down the individual partner and learn everything about that partner. And when you pitch, it's kind of like a job interview. You should know everything about that partner, and just track them down any way you can. Next bullet, corporate venture capital. Conrad, want to take that?
Well, we raised a lot of corporate venture capital at my solar business 10 years ago when I was in-house. Those are the venture capital arms of strategic buyers or corporations. The Google or Siemens or Cisco all have venture capital arms, and they're investing money strategically into startups that make sense in their business. The problem with corporate venture capital, unlike financial venture capital, is you have to assess what their motivation is. I mean, they're not in the game to go IPO or to reach a financial exit. They're investing in you because they're interested in having some control over your technology or your market, or keeping you out of a market. So you gotta understand what you're giving up in return for that capital. Are they going to limit your exit options? Are they going to put what we call a bear hug? Are they going to put a bear hug around your technology? Pros and cons, you can get a better valuation. Sometimes a more excited investor that you're giving up some of your freedom in order to do that.
Yeah, no, that's a great point. And a lot of that goes to the legal documents, right? About, how they can exit, who can invest, make sure they're not locked up, so to speak, right?
Yeah, well, you can build in exit scenarios so that if we reach a certain level of success, you're going to buy us out. But it still
Right.
limits, it's not an open market.
No,
It's
exactly.
yeah.
Exactly. From an M&A perspective, you want to have various bidders to increase the price. Okay, that's fantastic. So next bullet, the market has changed dramatically from a year ago, obviously 2 years ago. So you have to roll with the punches. And, it used to be like, hey, we grew 200%. That's fantastic. Please invest. It's not that way anymore. So they're all looking at the rule of 40. It's worth taking a deep dive on the rule of 40. Go to Wikipedia, whatever you need to do, but understand the rule of 40, understand examples. But basically it's pretty simple. So if you grow at 30% and annualized rate 30% and your margin or EBITDA margin is 10%, you've written the rule of 40, right? So you want to hit that 40. So that's the idea. If you're minus 10%, you should have 50% growth, right? Because that's 40. So that's the simplistic way to look at it. But it is really key in the financials. If you're in Series A, you're typically almost always negative EBITDA, but you should have a very detailed projections with a path to profitability. That's key. It should be realistic.
Yeah. Ben, why don't I give a quick tutorial here about accredited and non-accredited, and
Sure,
since we're talking about Series A. I mean, again, this is not a securities law webinar, but for the path of least resistance when you raise seed money, you raise Series A, certainly if you raise money above beyond Series A, is to raise money from what are called accredited investors. Those are investors who the SEC, the Securities and Exchange Commission, is deemed sophisticated enough to make the investment without the kind of public disclosure that a company makes in an IPO. That's why you have IPO rules, because that's sold to the public. So if you sell to accredited investors, typically you can do that with less less information, less disclosure, and it's more of a contractual arrangement. You can raise money from non-accredited investors. There are silos for doing that, but doing that is typically not recommended because it restricts your ability then in the future to raise money from accredited investors. You're all going to ask me, what about crowdfunding? Yes, crowdfunding is the democratization of the fundraising process. It's giving you basically a public forum for selling private shares to non-accredited investors. And in some ways it's an interesting platform. There are annual limits to how much you can raise. It's either $1 million. If it's over $1 million, you got to provide audited financial statements. There are limits to how much investors can invest depending on their worth. It's not the same high threshold as accredited investors. In fact, you can run crowdfunding financing, Ben, without and at the same time raise money in a private placement from accredited investors. So there's some cool aspects of it. Mm-hmm. The problem is, Ben, that you use a company like WeFinder or WeFunder. They're a platform company. They're not going to find those investors for you. You have to find the investors, and that's a heavy lift. You have to have a story. You have to have a narrative that makes sense for usually a consumer-oriented narrative, and you got to go find the investors. And frankly, if you're going to raise money from a bunch of small investors through a Reg CF or crowdfunding, it makes it harder in the future to raise money from sophisticated institutions. They don't want to share the cap table with a bunch of small investors. So that's just a very small recap. We can do a whole webinar on that another time, Ben.
No, that's great. That was very helpful. Yeah. So it's interesting. So I get a question for you. Say your parents come in for 1 million seed round, they're not accredited. How does that affect the later rounds?
Well, that's if they're gonna do 1 million and they're not accredited, being accredited means you have to have at least $1 million in assets or $200,000.
Call it 200,000 then. Yeah, they come in.
Well,
for 200.
200,000 is a different story. If it's your parents, you could bring them in as non-accredited investors and then wait the waiting period before you raise money from accredited investors. The problem is you wind up having non-accrediteds in your cap table. If in the future there's a down round or in the future you need to pay for play stuff, they're not going to be able to play. So I would tell you, if your parents want to give you 200,000, let them loan you the 200,000 and you put it into the company.
Smart. Yeah.
And avoid having both your dad and mom and non-accredited investors on your cap table.
Yeah, no, that's a great point. Have a loan. Okay. Next slide, please. So now we're at the B round and you have some traction. Your sales are cranking, you got the growth, larger amounts of money are included. You're broadening your range of investors. You're going from venture capital firms to private equity firms, other institutional investors. The amount's higher. Challenging, the amount of companies that make it from A round to B round is probably what would you guess? Kind of 10%?
Yeah.
It's a pretty small percentage actually. So if you're A round, you should actually, given the fact you've got a 10% chance of getting the next round, consider an early exit from M&A, get sold to a strategic. Because it's really hard to get to this round.
Or you roll up with similar companies to create a platform company that can raise a B.
Yeah, exactly. That's the M and M&A. People always think about acquisition, the A, but M is a merger. You can always merge with a couple of competitors, although it gets a little tricky there in terms of who's going to run the shop. So on the protests on the side there, it's a lot of companies are doing sideways round right now, which means that if you're having a trouble raising a B round, you're going back, or A round for that, and you're going back to your current investors on the same terms as their last investment for a bridge round, right? So the bridge round's pretty popular.
Or a down round, unfortunately.
Yeah, exactly. I think that's on the next slide. But yeah, down round is possible too. And why don't you explain the down round, Conrad?
Well, again, this goes back to what we were talking before about being careful about how you price your rounds.
Yeah.
It's great to get a high value, but if that high value doesn't sustain, you wind up in a situation where you have to raise money and at a lower price than you previously raised money. That's a down round, and that has lots of negative implications. It typically triggers anti-dilution rights in prior investors, so it's extremely dilutive. Not only are you raising money at a lower price, but the people that you raised money from before get the advantage of that lower price or some fraction of that lower price. And clearly, Ben, I mean, having been there myself, it's psychologically, it's difficult for the whole team, the management team and the incentive. And frankly, founders don't always survive down rounds. If you go back to your old investors and you tell them, I'm in trouble, I need more money, you do a down round, they're going to probably say, well, you're going to take so-and-so as your new CEO.
Exactly.
It's a difficult place to be that I've been at, by the way.
It can get ugly, from the M&A perspective. Selling a company at a lower valuation than our cap table is tough too. Then you spend 4 months trying to get the deal done, or 2 months with the different participants in the cap table negotiating what they get with all the preferences, etc. So yeah, it's good to have a realistic pre-money, post-money valuation. That helps a lot. And then the other thing is do non-equity, do venture debt. Revenue financing is relatively new. It's not factoring, AR factoring, which is next in bank loans. It's actually based on your revenue. There's a couple of new shops that have been very popular, and I've used them before for clients successfully. They basically just take the revenue, not your AR. Venture debt, and Conrad, we're talking about that, like Silicon Valley Bank is now out of the picture, and it's going to be much more difficult to get venture debt.
Yeah, I mean, it's not clear. It's not clear who's going to plug that product hole now that Silicon Valley provided a very important service to Silicon Valley Bank, to the startup community. They basically provided commercial lending on top of venture rounds. They were the security they received, was the comfort they received, was the approval of the venture fund that invested. And they mitigated the risk by taking equity in the form of warrants, which is an equity type instrument. That was critical because it provided liquidity. It provided liquidity for founders. They could buy houses. And it's a very risky business, and they were very good at it. And Ben and I were just talking about this, that the Silicon Valley business didn't fail because of the business model. It failed because they exercised poor risk management. But be that as it be, who's going to take the place of, if anybody, of Silicon Valley Bank is still a question mark at this point.
Yeah, the ironic part is that they had a risky business model that worked for years, but then they invested in treasuries, the safest financial instrument on the planet, and got in trouble because they didn't hedge.
Yeah.
But yeah, hopefully they get replaced by somebody. We'll see. It'd be interesting to see how that plays out. Next slide, please. So this expansion round, C rounds and beyond, you're looking at larger venture capital firms, private equity firms. There's a lot of dry powder private equity firms. And then, it's interesting to see just a lot of private equity firms buying public companies and taking them private, which is actually good for M&A because they tend to do add-ons to the portfolio companies. So if you're a later round expansion round company and you're looking at M&A, you should look at private equity for a platform company, which is a company that's strong enough to stand on its own. It's got super professional management. They've been to the rodeo before. They've done M&A. Then we use that company to acquire other companies. So if you're looking to sell, you can just sell to a private equity firm as a platform company, if you're big enough and robust enough, or as an add-on to a current portfolio company. You should look at both. Here we have down rounds again, which is once again lower amount than preceding round. And there's a ton of down rounds out there. And part of the key there is in this, when you're in a negative cycle like we're in now, is communication with your investors is really important, and not hiding things and seeking their advice. That's really important too. And preparing for the next upcycle, which is inevitably around the corner, as they always are. Last bullet point there, management carve-outs are important because, I've seen situations where the founders management team have, call it 10% of the equity. And really, there's no incentive for them to continue. So typically you want to have a management carve-out, which means they have 20% minimum of the company. So they have an incentive to keep running with the company and to sell the company eventually. Conrad, any comment on that?
Yeah, I mean, the management carve out is a way to make sure that the critical people in the enterprise have a stake in the game. The way we're going to talk about briefly in the term sheet is that venture capital money sits on top of the equity that's owned by management and the founders. So if there is, as Ben talks about, a fire sale or a down round, the founders and management aren't going to participate. And if investors are smart, they're going to carve out some equity so that there's some incentive for those guys to continue to function.
Yeah, or alternatively, like an M&A transaction, the buyer will give the management team restricted stock units, which are typically only for founders, not their whole management team.
Yeah, I mean, there's different tax strategies.
Exactly. Exactly.
Yeah.
Okay, we're actually got another 8 minutes, but let's go to the next slide.
Yeah.
The team is key. Lawyers are always very useful. I'd highly recommend using Conrad in general, but also for,
Gee, thanks, Ben.
yeah, no worries, no worries. Worked a long time together, but seriously, for early stage, especially, as we're kind of emphasizing how you structure your company initially, for seed, it's really important, and they can be helpful for contacts, finding financing documents, and term negotiation. I come in later as an investment banker. I do Series A, but only for rounds in parallel with M&A activity. So looking for a buyer as well as for capital. We're helpful for contacts, pitch materials, and term negotiations. Management. Go ahead, sorry, Connor.
I was going to say, the most important thing a banker and a lawyer can do for you is to help you level set market terms. I have something, I like to tell my clients, you got to play the game by the rules of the game. It's not a level playing field. I know a couple of years ago that the founders had more leverage in the negotiation of venture terms than historically they had, and there was this perception that maybe we're in the new age of Aquarius where everybody was equal. As Ben said, we're back to the means. There are a lot of terms in venture capital, and for example, liquidation preferences and anti-dilution rights, which may strike you as unfair. Why are the investors entitled to these rights? Well, that's the market, and you're not going to change them. And that's why, a lawyer or an advisor who's been in the space can help you understand, what the market is.
Yeah, no, that's critical. And it certainly changes every month. What do investors look for in an internal team, an extended team? It's changed a lot. I think the full-time employee is great, but a lot of people use consultants. A lot of people use international developers, software coders. That's pretty typical these days. So I would not be shy away from that. A just team of no track record. What would you say to that one, Conrad? No track record. How do you present yourself?
Well,
it's tough, huh?
Everybody has everybody has a history, right? Everybody has a narrative. Then the focus goes on your narrative, on your story. The stronger the story. You could be two kids out of Bowdoin who I represented a couple of years ago, and they had a really strong narrative, and that can overcome the lack of experience.
Yeah. Yeah, well, you think about it, like if your first venture, a lot of people had that happen. So you're right, it's your narrative. All right, next slide, please. We've got about 5 minutes, FYI. So
yeah, so let me talk about. I'm not going to have. I'm going to go this very quickly, so you guys can reach out to me directly if you're interested. A couple points, overall points on the term sheet and negotiation. Understand there's the principal difference between private equity and venture capital is that private equity buy companies. They buy majority stakes. Management winds up retaining rollover equity, but for the most part, they own the company. They control the company. Venture capitalists are minority investors. So when you're raising money from angel investors, you're raising money from venture capital investors, and at least in the Series A round, you're going to still be the majority holders of the company. But there's two things to understand. One, the minute you take their money, you don't have control over your destiny anymore. They're sitting on your board. They have veto rights over decisions you make. They have effectively a practical ability to fund you or not fund you in the future. So, when you talk about negotiating your term sheet, you're really talking about preserving as much independence or plausible path to independence as possible. The other thing, Ben, that's really important to realize is once you take investor money, you're on the clock. They're not going to give you 10 years to tinker with your technology to create the best rocket ship that Elon Musk can think of. You got 3 years, 4 years, maybe 2 years, before their fund runs out and before their patience runs out. So you've made a deal with the devil when you brought them in.
Yeah.
And you got to dance with the devil, or don't do it. Bootstrap yourself and don't raise the money. Here quickly, we're not going to have a lot of time here. Valuation, obviously, again, we talked about before. When you raise money, you're diluted. You're not issuing your own shares. The company is issuing new shares, so your percentage of the whole is reduced. You have to understand the difference between pre and post money valuation. Pre is the game here. That's where you put a value on your company. Post valuation is really the pre money plus the new money that's raised. Fully diluted. The investors come in on a fully diluted basis. So if you have a stock option plan, you have warrants, you have contingent equity, they're going to consider that equity as being issued. Founder vesting, they may ask you to subject some of your founder stock to vesting because they don't want you to walk away the day after they put money in. Preferential investor economic rights, they're going to want a preference, on liquidation if the company is sold. Historically, the idea was if there was a fire sale, they would get their money back first. But gradually, it's evolved over time that not only do they get their money back first on a fire sale, but on any sale. So they get their cake and eat it too. They can get their liquidation, they get their money back, and then they participate pro rata. And there's different flavors of liquidation preferences, but my experience is that it's going back to the means, as Ben talked about before.
Yeah.
Finally, quickly on investor control rights, and then you can, and Ben, I'll turn it over to you. This is what we were talking about before, is your path to independence. Who can, in an American company, the board controls all important decisions, and the investors are going to want to have, a seat on the board. They're going to want some independence on the board. They're going to want veto rights over major decisions, and as a practical matter, they may have the ability to control your fundraising in the future.
Yeah, fantastic. I think just one point here is that venture capital firms can be very, very useful and bring you to a great exit or an IPO exit. But at the same time, you have different interests, right? They have an interest in hits and home runs, and you may want to get a double and exit earlier. But you're going to have conflicting interests. And then venture capital firms have their own investors. They have preferred investors. So it's important to understand, your venture capital firm, have they raised enough money to fund you for the next round, and what their status is. So do some due diligence on your venture capital firm that's interested in investing in you. Next slide.
1 minute, Ben. So let's just quickly deal with due diligence, and then we'll go to Q&A.
All right, sounds great. Go ahead.
Well, again, we talked about this before. There's going to be an exercise where the investors are going to do a proctology exam on your company, and some key takeaways here is, as we said before, it's never too soon to start preparing for that and using a tool like ShareVault to organize your documentation, and getting that discipline is always really useful. Making sure your financials make sense. I mean, this whole game, venture capital and M&A is usually based on some multiple of projections, multiple of EBITDA. You got to stress test your financials. It's not just your brother-in-law around the corner who's doing things on a cash basis. They're going to be looking at GAAP. You got to run GAAP simulations. You got to use defensible assumptions. You probably won't have the money to get an audit, but maybe you can get a review, so you get some comfort level for the investor that your numbers make sense. You want to clean up your messes, Ben. I mean, these venture capitalists, they see dozens of deals a day. They're looking for reasons not to do your deal, and they don't want to walk into a lawsuit. So whatever you could control. Scrub your chain of title to your IP. That's really the critical thing. You can't imagine how many clients we have that have holes in their IP. Everybody who's touched your IP needs to have executed an assignment of the IP. start your virtual data room, get your equity and stock options grants documented. There's a lot of good tools out there like Carta to do that.
Yeah.
Look, your most important asset in your negotiation with the investors is your credibility.
Yeah.
The better you look, the more credible you are, the more negotiation strength you have,
Yeah.
and the opposite. If you
You
look
can
like
tell,
you're completely
Conrad, by looking at,
disorganized.
you can tell, Conrad, by looking at a company about 5 minutes if they're organized and well documented, right? It's interesting. So,
Yeah,
you know,
and people make judgments. You only have one
yeah,
chance to make a first impression.
exactly. Okay, well, great. Looks like we have questions. So let's go to the Q&A session. Thanks, Anthony.
Yeah, thanks so much, Ben and Conrad. That was outstanding. I know I learned a lot. And so we received some good questions in the Q&A module. So I'll just kind of go through those. So we have one from Martin, and it says, we're going out for a round of financing. If you go out with a firm target pre-money valuation, assuming yes, how should they arrive at a target number, and where are the key drivers they should cite to support their ask?
Well, let me give my point, and then Ben, you can talk about the technical aspects. I'm not a fan of going out there with a fixed value. I think you have to have a range in your head, because the market's going to tell you what your value is. When you start telling professional investors what the value has to be, they're going to walk out the door. That said, Ben, there's lots of ways to get some market feel for what you should be valued at.
Yeah, I think that's right. I wouldn't go with the number either. I mean, you shouldn't put like 5 million on the table, my 5 million pre-money Series A, or call it 10 million pre-money Series A, and I want 5 million that's 15 million post. I wouldn't do that because they're going to decide, the investors. On the other hand, you should be prepared. So look at the comparable companies in the public markets, look at how they're trading, look at precedent transactions, which means that private companies getting sold to public companies. Look at those valuations. Are the EBITDA multiples, typically the revenue multiples? What's the revenue multiple?
And lean on your advisors, Ben, because they know best.
Absolutely.
The law firms and the bankers that are in the space, they're going to know best what companies are trading at in your space.
No question.
But don't be dogmatic. Don't show up with a spreadsheet. That I got clients that have spreadsheets showing we're going to raise this much money, and then I'm going to have this, and then we're going to raise this much money. It doesn't happen that way.
Yeah. If you can get, some chunk of money to get to the next stage at a reasonable valuation, you don't have to go for the gusto at the very first instance.
No, great answer, guys. So next question comes from Amanda, and it is, considering the current macroeconomic environment, what's the current funding environment?
It's much slower than it was. There's no question about it. The venture capital firms are slow to invest. Angels are slow. Everybody's taking losses on their own portfolio, right? So there are pockets, as Conrad was saying, in certain sectors that are hot. But that said, there's still funding going on. You should look at Crunchbase. You should try to sign up with newsletters that show you what funding is going on, and just be very targeted in your approach. Find out which venture capital firms are still investing in your space. That's really key.
Great answer. So the next question comes from Amr, and it is, you talked about sort of the balance of taking money or having strategic advisors earlier. Could you go into more detail about the balance between that? Should I take more money from someone who's not necessarily considered a strategic advisor, or less money to get the strategic advice?
Well, strategic advisors, you can buy them with equity. You give them, a stock option if they're individuals. So, that's, and there's rules. You have a board of directors, you have a board of advisors. You put people that are prominent in the industry and that can actually give you good advice on your board of advisors. They're effectively consultants. Then you can use equity as currency to compensate those folks. Give them a quarter a point, to half a point. It depends on their status. Doesn't necessarily have to be related to fundraising. Fundraising, a whole different animal. You're raising money from investors, and there you have to make a decision as to whether you want to raise as much as possible or just as little as possible, factoring in what the dilutive impact that's going to be on you, because your interest in the company is going to be diluted.
Yeah, sometimes it's helpful to have a board of advisors, just make it light for them, make it like once a quarter meeting. But it's good for your credibility if they can be listed on your website as an example for fundraising. You can give them a point or two in equity. Sometimes they don't require that, but it is helpful.
Okay, no, great answer. Okay, the next question comes from Simon, and it dovetails exactly into what Conrad was saying. You were talking about dilution. How much equity should I expect to give up for, I guess, let me paraphrase. How much equity should I expect to give up in an early stage?
Well, let's, look, first of all, let's understand what dilution is. Dilution is you as the founder, you are not giving up your own equity. There is no path to do that. The company is raising money by issuing new equity. So you have to think of it as a pie. The pie is 100%, you and your partner own 50-50. Now you're gonna issue 20% to an investor, so you and your partner are going to own 40-40, and then the other 20 is going to be owned by the investor. What can you expect to be diluted? Look, most Series A rounds, even today, are being priced in the $5 million pre-money valuation range. 5 to 10, and some are even lower. So then it just becomes math. Let's say you're priced at $8 million of pre-money valuation. That's what the market will bear, and your investors are going to invest $2 million. So you look at your post-money valuation, which is 8 plus 2 is 10. Your investors are going to get 2 out of 10, 20%. So Ben, in a typical Series A round, you're giving up 15 to 30% in my experience.
No, that's exactly right. It's exactly right.
Okay, no, thanks so much, guys. So we're approaching the top of the hour now, and that concludes the webinar. If we did not get to your questions, we will go ahead and answer the remaining questions directly and send them out to the people that asked. I want to thank Ben and Conrad again for sharing all this information. I mean, this is a wealth of information. Thank you guys so much.
All right, it's our pleasure.
Yeah, it was great. Thanks.
And thanks everyone who attended. A quick reminder, we'll be sending out the recording and the slides within 24 hours. Don't hesitate to reach out to Ben and Conrad directly. You can click on the QR codes on the screen to get their contact information. Please join us next month for the next webinar in our capital raise series. What you must know when negotiating your fundraising term sheet, what's a big deal, and common mistakes to avoid. Use your phone to click on the QR code on your screen to go ahead and register for that now. Thanks again, and see everyone next month.
Thanks, guys.